Hello, this is Eddie Gabor, co-founder of Key Advisors Wealth Management. Please subscribe to our YouTube channel, visit us on our website, or email us with any questions that you have in regards to the content in today's video. It's been a while since I have published a video to go out to the public. As many of you know, I lost my son on July the 15th, and I've received a tremendous amount of love from people around the country on Twitter, just sending me messages, emails, cards. And so I'm using that as motivation, as a way for me to kind of give back to you for that love you've given my family. We've continued to give our clients updates through our videos, but nothing to the public. So I just want to spend some time and talk about the setup as we go to post NVIDIA earnings and what we are doing right now for clients. And maybe this will help you and your family as you manage your own portfolios. Just remember, everything I'm sharing with you is our opinion and what we're doing as a firm. It doesn't mean it's suitable for you or your family. You have to make that decision on your own. But I hope what I'm going to share with you is going to bring some value. So one of the biggest things here post NVIDIA earnings, which by the way, I don't think I've seen in my 26 years one stock that had such large anticipation for earnings, but rightfully so. We've never seen a stock, in my opinion, that has so much ownership on a percentage basis, and obviously it's a big weighting in the S&P. And so right now we are heading into the month of September, in which we believe September will be, and October, potentially pretty volatile with a little bit of a correction potentially to the downside. We are not bearish. We haven't been bearish this year on the market because we don't think we're in a recession yet. And the economic data continues to support that. So the setup here between now and year end, we still think is pretty bullish, because when you kind of boil it down to simplicity, you have a Fed that's going to be cutting interest rates when you're not in a recession. So as a whole, to me, that's very bullish. You're getting stimulus when an economy may not actually need stimulus. Now, there's a lot of debate in regards to some of this data that's out there, and I could debate it as well too, because there's certain areas that are really struggling and other areas that are doing okay. But overall, no one can argue with the fact that things are stronger than what we probably would have anticipated 2 years ago at this point in time. However, we are now going into seasonality that generally is weak in an election year. And I believe this election will show plenty of volatility due to the media following it 24 hours a day. We have a debate that's coming up. And so the things that we're watching for September is our Fed meeting. One big risk over the next 12 months is I don't think the Fed's going to cut interest rates nearly as much as the market has priced in. Okay, I'll get to that in a minute. But we know, or at least firmly believe, they're going to cut at least by 25 basis points in September. So that's already baked in. The one area that could cause some surprises is the Bank of Japan. The Bank of Japan, one could argue, is more important than our own Fed, because Japan has gotten some really hawkish data on the labor and wage side. And last time they just raised rates by a quarter point, you saw what it did to the market. Their market dropped by about 25%. We had areas in our market crash, and we had a VIX hit 80. That was just unprecedented to see that type of move in a short period of time. So we're going to be visiting that type of scenario again in mid-September. So what we've done as a firm is we have taken advantage of this bounce that we saw in August, this V-shaped bounce. And as I'm recording this right now, post NVIDIA, we are raising more cash. We want to go into September, October with at least a 30 to 40% cash position for clients. We believe that's prudent. If the market continues to grind up, we'll still do well, in our opinion, to our portfolios. But if we get the correction we're expecting pre-election, we will have an opportunity to really buy things at a lower price than where they are right now. And because of that, we think we could potentially see a really nice snapback post-election. Now, of course, if anything changes on the technical side or fundamental side, we won't buy or we'll sell more. But right now, if I had to tell you what our viewpoint is on the year, is you could see a 7 to 10% correction, September, October time period, which we would want to buy. And then post-election, barring that there's a clear-cut winner, you could see a really nice fourth quarter rally. Now, we want to take advantage of that. Now, the biggest concern that we have that no one is talking about, but we have been talking to our clients about it all year, is next year. And we ask ourselves, what is not priced in for next year? Next year, we think you're going to see inflation reaccelerate. You could even see growth accelerate. By the fourth quarter of this year, which we won't get that data the first quarter of next year, if we see inflation reaccelerate, the Fed, in our opinion, will pivot. They will not cut rates. I'm not saying they're going to raise rates, but they will stop cutting interest rates, in our opinion, if you see a reacceleration of inflation, especially if you see a reacceleration of growth and inflation. And we think there's a very high probability that you see that. And if we see a scenario like that that is not priced into the market, you could see a sizable drop in the equity space. So right now, we are positioning ourselves to be defensive going into September, October, because of the BOJ, because of seasonality, because of the election, because of maybe the Fed being more hawkish than dovish due to the data in September. But we are going to play a fourth quarter bounce post-election that could be pretty violent like last year if the setup is what we hope and anticipate it to be. But then we will more than likely, if we are right on inflation, we will hopefully see it before the numbers are reported and before the market reacts. We will become extremely defensive because we will see a scenario very similar to late 2021 going into 2022 next year. And so I normally don't try to lay out our predictions that long, but again, I haven't shot a video for you folks that follow us on Twitter and that are non-clients for a while. So I just wanted to kind of put some real detail into what our prediction is based on the data. And then you can hold us accountable to see if we are right or not. So that is a setup that we see here over the next few months. So by no means do we think we see a crash here imminently unless there's some black swan event, which could happen, something with the BOJ again or the Middle East. But our playbook is exactly how we've laid it out. Choppy September, October that we want to buy with the 30 to 40% cash we have raised in this V-shaped snapback because we don't think the market's going to go straight up between now and election. So we want to buy that dip. And we want to take advantage of the potential post-election rally, and then it's going to be risk off if we are right on inflation. So the biggest concern I have is for next year. I don't see anyone talking about inflation reaccelerating. I think everyone is going to buy into this notion that inflation is decelerating and the Fed is going to be in a rate cutting cycle all through next year. I do not believe that's going to be the case. And if we are right, we will have our assets protected so that way we can take advantage of any type of drop in the market. And again, we are able to change our opinion at any time that the data changes, but right now that's what the trend is pointing to, is people are going to think we're winning the war on inflation because the headline number's coming down this quarter. But again, I think by the end of the year, we're going to see that reacceleration. And this is why we think this is a time to be very active with a portion of your portfolio. Because at the end of the day, it's real cool to come on TV and say, buy the dip. But if you didn't raise any cash, how can you buy the dip? So that's always been my question is when someone says we're going to buy the dip, my next question is, did you raise cash or are you just saying that because you think it's a buyable dip? Because at the end of the day, it could be the best price you could ever wish for, but if you don't have any cash to buy it, you're not able to capitalize on that. So that's how we are playing it. So we are hedging our bet here over the next couple of months due to the volatility, and we are going to be ready for what we could potentially see happening next year. So I hope you got a lot of value out of this. If you have any questions or you want to attend one of our webinars, email us directly. You can go to our website for our email address. I will do my best to personally respond to everyone that reaches out to us. And again, that's a thank you for all the love and support that you have given me over these really tough 6 weeks that my family has gone through. Thank you, God bless, and have a great weekend.